we're here today to discuss our 2024 federal budget debrief. So I was watching that during dinner last night. Had to turn the Netflix off and then the good old news channel back on. But we're here to discuss some of the stuff that will be relevant to business owners, individuals, and yeah, just kind of unpacking the stuff that will be relevant. There's quite a lot that they cover during that federal budget announcement. But today we've kind of sifted through the stuff that we think will be relevant. And yeah, there will be also opportunities for any Q&A as well along the way. So if you do have any questions, please use that Q&A section and then we'll be able to sift through. On the screen today, we've got a couple of people, our team members as well, Rose, Tay, and Glaze, and my co-presenter, Ben Walker as well. So I'll take you guys through, if you don't know who we are, just to start, we're Inspire Accountants, and we've been around 10 years last year now. And during that time, we've done some cool stuff with our clients, and we've saved over $31 million in tax for our clients and counting. In fact, this time of year is actually a really busy period for us. It's that time where we talk to all of our clients about how we can save them some tax before the 30th of June. So this federal budget debrief has a benefit of doing so as well. As we've seen in the last few years, a lot of changes come in last minute, thanks federal government, that we need to implement sometimes before 30th of June. So we're actually, I don't know if we can post our live tally right now in the chat somewhere, but we do have a live tally of where our tax savings is over 31 million right now. Really proud to say that. And I'll introduce you to also, and for those of you who do need that help of proactive tax savings and just a chat before 30th of June, there's no obligation phone call that you can jump in and book with us. There's a link that Tay just posted there where we are open to have that conversation with you guys. If you haven't spoken to your accountant or you haven't spoken to anyone about your taxes this year, book that call. Our team is obviously ready and available to have a chat to you. And yeah, it's something that's a recent development for Inspire. Well, not so recent. When did you launch this book, Benny?
November at the 10-year.
Jeez, yeah, it's gone quick. This calendar's gone really quick. So you want to talk a little bit about your book, Benny?
Yeah, so I published this book November last year, and what we include in that is a whole heap of information around the basics of how the tax system works for small business owners, but also a lot of detail on the business structure. So things like companies, trusts, the difference between them, and how your structure might need to change as you grow or go throughout your business cycle and life cycle. And then a heap of strategies on tax savings. So that's that last third of the book. But yeah, that is, I think it's about $50 on their website. The QR code is there if anyone does want a copy.
Yeah, and yeah, we're going to cover the tax side of things today. And if you are a business owner and you're keen to kind of get a little bit of a rundown how to best structure your affairs and your taxes, it's a great book to read into. But this is the key principles which we run Inspire on when we talk to our clients. So thanks, Benny, and well done on your, is that third? Second? Third?
Depends what you count as a book.
Let's call it third, hey?
Yeah.
Cool. With that in mind, if you don't know who Ben Walker is, Ben's our founder of Inspire, and he started Inspire at 23, a young wee lad, and he's won many countless awards as a chartered accountant, but also his experience in accounting, just under 20 years there. And yeah, it's in terms of the author of Wealth for Life and It's All Sorted. Now, this is another book. But that's the one that Benny says, whether we count that as a book. I count it because he put a lot of it. He's also a family man, and that's what our main principle here inspires. We put family first, and you can see, Benny, thanks for sharing photos of your family. I think you're expecting number 4 coming
Yeah,
soon.
number 4 in about 2.5 weeks away. So slightly nervous about that one.
He's definitely got the parental experience that I try to draw upon as I only have number 1, which is a little bit about me. Actually, interesting enough, I actually made partner this year, so that actually has to change. And I'm a chartered accountant. I've over 10 years of experience, and I joined Inspire in 2016. Not really a new dad anymore. He's a year and a half, but starting into that kind of dad phase, family man phase. So there's a lot about from a family perspective. I've got a lot of opinions to share today as well. what has the budget impact? How does it impact families as well, especially young families? That's enough about us. Today, what we're going to cover is, like I said, three main parts. When we looked at the federal budget announcement, we were really trying to identify what are the key points for small business owners, individuals, and also if you have a self-managed fund or if you have a retail fund, how does that impact you as well for your retirement? So those are going to be the three lenses that we're going to look through. And essentially where the federal budget goes through is quite a lot of stuff, even like things that are not so relevant for small business owners, but somehow impact us from an individual perspective as well. We'll take you through all of that. And we'll also cover off a little bit towards the end about what is still in front of Parliament or not yet law or in progress that we were expecting to hear from this budget that we didn't. So we'll take you through that as well. Now, just to preface everything, the overall, Ben and I talked about this before, the overall kind of view of this year's budget is very limited towards small business, really. And I think if we look at kind of the last few years of the budget announcements, especially through the COVID times, there was a lot of changes that impacted business owners. And obviously there's been a change of government as well, and we expect those tone changings, but also from an economical standpoint, it's a very different economy than it was 2-3 years ago as well. So we'll talk about overall comments of what we think and where it's heading right now. But essentially, there's not too much for business owners this year. There are a couple of updates. The main one being, and this has been talked about from last year to this year, and it's still being talked about as well. One of the measures was to extend the 20K instant asset write-off. Now, as small business owners, if you buy an asset excluding GST less than $20,000, you're able to immediately write that off. Now, that's changed over years. At one point, it was unlimited. At one point, it was 150K. Now it's 20. Now, the reason why we put this as an extension was it was earmarked to go down to $1,000 at first originally, and essentially now that's moved across into this financial year and into next year as well. We're looking at still extending that 20K instant asset write-off. I'll cover this again later at the end because there is still conversations that's happening in front of Parliament right now whether that goes up to 30K. And we haven't got that update this year, but it's just extended right now while they're still having that conversation. So that's the business owner side.
Just a thing to remember with that, there's less than $10 million. So that turnover limit was a lot higher in previous years. It's $10 million revenue limit. So there's a couple of clients who breached that on the call. Keep in mind, if you're over 10 million rev, you got to revert back to the old school depreciation rules.
Yeah, and as a small business, you can write off the value of the asset if it's worth more than 20K at 15% for the first year and then 30% every year after. That's called the small business general pool. And that's been there since, it's been there for a while now. It's just that we haven't used it for a while because at one point it was unlimited. You could just write off all the assets. So it's back to that now, but which is semi good news, but still to be heard. Obviously the unlimited days and 150K thresholds are gone now. We're kind of back to that 20K onwards. Cool. The next bit we have is around individuals. Now, business owners are individuals too. So technically there is a bit of a connection here. The first one we'll start off with. Did you want to try this one, Benny, with the HEX side of things?
Yeah, so my interpretation of this is that HEX was pinned to CPI, but the budget adjustment here or announcement is to pin HEX on the lower of the wage price index, WPI versus CPI. So, and looking to backdate or back amend the indexation from 1 June 2023. And sorry, just on that point there about turning back the clock on last year, so the increase in balance we saw with HEX on 1 June 23, are they looking to amend that, or is it just from 1 July 23 onwards?
So it will be from 1 July 23 onwards, and amending the past one, sorry. So anything that was indexed in the past. So essentially what's happening is we're looking in 2023, the indexation was, before this amendment, was at 7.1%. It's going to be 3.2% in 2023, which is a backdated thing, which is great because a lot of people got this big shock when CPI went through the roof, and then their HEX debt just went up by another 4K. If you had about 25K in HEX debt. Now, what that means is that they're going to go backwards. If you have HEX, you're going to see an adjustment in your HEX debt account, where this is kind of a little bit of a cheat sheet. If you had HEX debt at 30th June of 2023 of, let's say, 25K, you'll see a credit of about $1,000 that will come through in there, because the increase would have been, it's nearly half, right? So if you look at the difference that they're using for indexation, you would have seen an increase of about 2,000. But now they're crediting about 1,000 back, so nearly half of that. They're essentially changing. They're calling it wiping it off, but they're changing how they're measuring it as well. Now, for 2024, the current year that we're in, that's going to finish in a few months. There would have been an indexation happening at 4.7% if it was CPI, but with WPI, you're seeing that drop to 4%. So really, the bulk of the increase or the initial shock is being softened here, and then it's kind of matching the wage price increase instead going forward. So that's good news for people who have HEX, especially large amounts. You can see the credit's huge here. That would be a double degree probably at that point, or multiple degrees. Or a vet degree. You're right. So big ticket ones.
Yep.
You're speaking from experience there, Betty.
Yes, my darling wife. Yep.
And so it is a significant injection, and it does mean that, from how does this impact you, is when we do your tax planning or we do your tax return each year, when we're entering your HEX debt balance for this financial year to kind of calculate that, we need to take into account that it didn't go up as much, so your repayments might be lower going into the next financial year, which is good news. Cool. The next one is super for parental leave. Now, this is something that's kind of been a bit of a hot topic that's been talked about, again, for individuals and growing families. If you're planning to take the government-funded parental leave payments, previously there was a disparity where whichever carer that took that leave doesn't get paid super. So obviously, more often than not, it'll be the mom that's doing that, and they have this kind of disparity of like super between husband and wife. And essentially, the idea there is that they're going to pay super on top of that parental leave as well. So that starts from July 2025. That's one of their ways to bridge that retirement savings gap between women and men here. Good news for growing families who are thinking to have some time off as well.
And that's that. Sorry, just on that. That's the 18 weeks usually for, is it, they call it the primary carer?
Correct.
And 2 weeks for the
for let's say whoever's doing the second shift, I'd call it. Which is great, which means that the government will be funding that. The key item here is that the government is funding that. So usually if you have parental leave packages with your employer, that you just have to look through whether or not they have super paid on top of that. But here it's going to go direct to your super fund instead of in your hand.
Very good.
Cool. Should I take that one, Billy?
Yeah, for sure. This one's a pretty straightforward one. So households and businesses will receive a relatively tiny rebate on their electrical bills. This one's going to be dished out by a quarterly credit on the energy bill. And it's just to take the edge off the increased price of good old energy that we've experienced over the last few years. Yeah, pretty straightforward one. Nothing to action to get this one. It'll just be sorted on the on the end of the energy provider.
Yeah, so you should be able to see that in the bill. Yeah, that's kind of like back and forth. So there's some people who have solar won't get it, and they're saying that people who have 10 investment properties will get it as well. So targeted or not targeted. 10 times. Yeah, that's right. So there's a bit of like kind of commentary or like like any of the measures, and we'll talk about that a little bit later. But at the end of the day, what they're trying to do here is And this is what we're seeing is there's this constant balance that the government's trying to do between the inflation that we're seeing, the cost of living crisis we're seeing as well, where effectively economy 101, where there's a budget, if you spend more money, it's going to activate the economy. And generally what it means is people spend more money and prices go up. So to control inflation, usually what it means is to reduce spending, to withhold as much spending as possible, to slow the economy down a bit. So it's interesting when you see things like this, and we'll talk about that a little bit later in terms of like our overall comments of what I see. But this is a twofold: spending but reducing cost of living expenses as well.
Just flipping back to that rental property example. It seems though that usually the tenant pays the electrical bill, so the tenant should get the benefit in that instance, unless it's some other form of accommodation where the landlord is paying the bill.
That's right. Yeah. So
Yeah.
whoever's account you see it in the bill, if your name's on the account, you get that essentially.
That's it. Beautiful.
Cool. Medicare levy threshold. Now, so Medicare levy is not the Medicare levy surcharge, but rather the 2% that people pay for having a Medicare card. Now, there is a low income threshold, meaning that if you earn below a certain amount, you don't have to pay that Medicare levy. You still get access to Medicare. You just don't have to pay that Medicare levy in your income tax return. They've just indexed this essentially to go up a little bit. So if you're single, previously, if you earn less than 24K per annum, you don't pay the Medicare levy. But now it's gone up to 26K from 1st of July 2023. That's just different scenarios there with families. That's combined income, obviously. So it's really just times 2 of that. So where you see that indexation has happened is along with the increase in salaries that we're seeing right now. That's just to kind of keep it within market. So what that means is, yeah, if you have, usually this is the case where, if you're starting out, casual jobs, you're 18 or you got children that are 18 or 19 and they're just about to start, they get a little bit of a discount on not having to pay the Medicare levy if they're earning below 26K. Talking about threshold changes and cuts, did you want to take through this one, man?
Oh yeah, it's a good one. It's actually pretty good. It's pretty good for most people. But yeah, so stage 3 tax cuts, they were announced a couple of years ago. Albo had a fiddle with them earlier this year. And what we're going to see is on the left-hand side, these are our current tax rates that we've been on for a little while now. And on the right side is the 2025 financial year. Now, we've tried to highlight the instant differences between the two. The key is we've got a 19% threshold going down to 16%, which will probably benefit, well, it will benefit most people, including higher income earners at that threshold level. So we're dropping on 3%. Now then the next one here, we're dropping 2.5% on where I feel like most of our clients sit when we try to plan their taxable income around that previously 120K mark per person, where possible, where the business structure and type of income allows it. But now our magic number, so to speak, is going to 135K, and we get a 2.5% discount on that as well. If we have a look at the next two thresholds, we're sitting at 37, no change there, and 45%. Ouchie, ouchie. But the threshold numbers do go up. So we go from 180K up to 190K for that 37%, and then plus 190 instead of what we were on, which is over 180. For that one there. So, yeah.
And there's a couple of things practically, obviously you can read this anyway, and practically for the clients that have been with us, especially when it comes to tax planning, we talk about these numbers quite often. We talk about the idea of a magic number, and really it's looking at this tax rate and comparing it to like a company tax rate. So if we look at a company tax rate, it pays 30% tax if you're not a small business. It pays 30% tax, and that's where it's getting closer to that tax rate itself. And I won't go into too much about this, but it really informs us of whether to retain some profits within business or to take that money out this financial year. There's a strategy around that we need to be mindful of, because the tax rates up to 30th of June 2024 is still here, this financial year that's ending in 2 months. But from 1st of July, essentially, it's cheaper to have some money in your name. So I'll let you guys put some, connect the dots a little bit together there. But it just essentially means there's a bit of a strategy that we can look at where available, of course.
Yeah. So essentially this changes a few things like, getting those, managing your Division 7A loans will be cheaper next year versus this year. Also, when you've got a 16% tax rate at that 18 to 45K level, that's very close to the superannuation concessional contribution rate. So often clients will say, well, do I put a bit of money into super or don't I? It depends on their income, but at that lower income between sort of 20 and 45K, it may not make sense to save 1% to chip it into super, to lose access to it until retirement age or some condition of release. So, yeah, they're the sort of considerations that this sort of changes. And yeah, I sort of feel like this is definitely a welcome change and a welcome benefit to most people. And thankfully they've also increased those thresholds or those brackets because at the end of the day, if we look at the left hand side and apply inflation or CPI to that, maybe we're sort of getting back to what it originally was when those brackets were announced.
That's right. And Medicare levy is still there. That doesn't change. Obviously,
Yeah.
that 2% is on top of that. And yeah, I guess the threshold's still changing, the tax rate's still changing. We're gonna see some tax savings, and that's the intention. Again, interesting move here with the Albanese government coming in halfway, changing it, and where kind of my where I see some of that change happen is driven by a couple of things. It could be, is my opinion, is it could be because of the rising costs as well, where the tax cuts might have pushed more money into the economy to push inflation up. That's kind of the central conversation that's been happening in that federal budget is it an inflationary budget? Is it an inflationary budget? Are you making things worse? And yeah, whether or not it works or not, that's remain to be seen. But I can kind of see where they're coming from here, from my economy 101 units that I've been taking in uni back then. So and the next bit here is around super. So there's a couple of changes in super. First off, this wasn't really talked about in the budget, but rather this is something that we know that's happening from 1st of July 2024, like in a couple of months. We're going to see that the super contribution cap is going to increase for concessional contributions. Read that as pre-tax contributions, going from 27,500 to 30K. Now, your non-concessional contribution cap, i.e., post-tax contributions, is going to go up from 110 each per year to 120 as well. What that means, that effectively means that your bring forward rules where you can use 3 years worth of non-concessional contribution in 1 year is going to increase from 330 to 360. That's just that 110 times 3, 120 times 3 years into 1 year. Couple of things that are practical about this is obviously you'll be able to move a little bit more money into super and having that tax deduction as well, saving you a little bit of tax a little bit more tax FY, because from a super perspective, any income before it's a pension phase super, an accumulation account, any income that super makes is taxed at 15%. Now, going backwards to this slide before, we can see you can still make some tax savings at this rate where if it's at this rate, you're basically paying 15% in super, but then you're saving 15% outside. So that's that net saving of 15 there. That's where Ben was talking about here. This rate now, there's a bit of a question mark whether it's worth doing that if your income is already below 45. Because really, we're paying 50% in super, but it's 16% outside. We're saving 1% at the expense of cash flow that is locked up in our super until we retire. So we've really got to understand what's your cash flow position like, and whether or not earmarking some of that cash will make sense for you. Obviously, if you're going to go buy a personal home and things like that, you need a bit of cash outside. Yeah, but maybe not worth it if your income is at that level. But again, depends on your situation, of course.
And with this one, and unless they change the way these caps are, like the value of them, like make up a new set of caps. These ones are always indexed, but they index each year in the background, but then kick in at a certain step. So the concessional kicks in, it needs to reach 2.5 grand for the step to kick in. So that's why it's going from 27.5 to 30. And the non-concessional has a 10 grand step. So I don't expect, given inflation hopefully comes back to a decent balance, I don't expect these caps to move again for maybe a while.
Yeah, and it's an interesting kind of point. Are we at the top of the mountain right now? And that's kind of the conversation everyone's kind of trying to identify. What does the future look like in terms of the economy? Cool. Do you want to take that one, Benny?
Yeah, oh, a relatively basic one. This is sort of more of a reminder, yeah, than a
Mm.
budget announcement. But as the clock strikes the 1st of July, in a month and a half,
Yep.
the superannuation guarantee, or the super we pay on wages, goes from 11% to 11.5%. Keep in mind, there's a couple of things for employers to consider here. If your employment contracts are done with a remuneration package inclusive of super, technically that means that your employees' gross wages will decrease by that 0.5%. But if your employment contracts are wages plus super, that's a cost that the business will bear from another 0.5%. And also keep in mind that that's if you're in payroll tax territory, that'll knock on to a little nudge up there too.
Yeah, we've seen this increasing. And then the last few years, there was a little bit of a pause, but it's been increasing very slowly. But yeah, just a reminder, 1st of July, that's going to happen as well.
And I think
Cool.
the goal is to reach 12% eventually. That was always the intention because I think super was 9% back in the day,
Yeah, nine and
ratcheting
a
up.
half, 10 and a
Mm-hmm.
half. I can't remember now. Cool. So that's the big items that we see in terms of kind of what's relevant for business owners and individuals and small business owners and growing families. This kind of section is a bit of an overall comment, a bit of opinion. Feel free to whatever you want in there. We're neither ways on political side here. At the end of the day, it's like what I see, and this is my opinion. What I see, what's happening right now is there's a lot of talks about bringing it up to budget surplus. They're really proud on, hey, we have a surplus in the budget. We have a surplus in the budget. And the idea there is surplus means I make more than I spend, right? So there's more in the coffers. And the resounding effect of that is essentially not putting too much money in the economy, pulling back on spending, trying to reduce this inflation, which kind of leads to that cost of living crisis that we're seeing where you go to Woolies, I can't remember now. I think I spent like $150 on a handful of items, buying stuff in the supermarket. And it's really interesting to see how this budget surplus might change some of that. But whether it really directly affects consumers or not, and whether they go out and spend, that remains to be seen. But that's where I can see what they're trying to do with this budget surplus. But it's interesting because when you're doing tax cuts and you're giving money away for electricity bills, and there's other things as well that they're doing to spend as well, that actually generates a bit more income and GDP and inflationary pressure as well across the board, and that means that interest rates will also keep going up because that's the other tool that they have is they spend more money and inflation goes up, and to bring it down, banks or the Reserve Bank will have to increase interest rates to get people to spend less money because there's pressure in their household budget now. So it's an interesting kind of pull push and balancing act they're making, and I think it's where I'm seeing it is kind of is this, and everyone's hearing it, right? This last month, interest rates has been on hold, and there's been predictions that it's going to go down. And I think everyone's playing this little, let's wait and see and do little bits and pieces here. Well, Jim Chalmers did say that this budget is for decades to come. Obviously, that's whether there's a political agenda on that or not, I'll leave it up to you guys. But apparently, it's for the future as well. Now, what they're trying to say is, if the next government or the current government keeps going with this budget, it'll fix all our problems. We'll see. I don't have a crystal ball. That I don't think anyone does. But that's where I see some of these moves they're making. Is to balance between spending money and not spending money as well. The last little point that I have there, I just want to kind of touch on quickly, is an interesting kind of I want to call it noise, but what everyone's been talking about is around this. There's not enough houses. There's a lot of people coming from overseas, and kind of taking up this space and causing it this housing crisis on top of a cost of living crisis as well. And what they announced in the budget as well is actually to cap migration and students coming across as well, international students. And interestingly enough, what they actually said as well is that the students that are coming in, if the university wants to take more students than the cap, the universities have to provide student accommodation at their own expense, which is really an interesting point because what we see there is whether it will totally stop migration, because that's one of the big kind of inflow stream of migration, which is through the student path. Whether we see quite a bit of that slowing down, we don't know. On top of that, the government also is putting a bit of money into affordable housing as well, where they're building government housing to help with the pressure of the demand for housing as well. So I can see where it's not just about spending money or not spending money. It's like, what do they spend on also is really important. And this change in policy might help with some of that pressure that we're seeing with housing prices. Good or bad, not sure. Obviously, if you're in the market with property already, yeah, it's good seeing the last few years going up in equity and prices across the board. If you're trying to get in the market, obviously, yeah, it's a bit of an uphill battle if it's your first home and things like that. So there's always two sides to the coin. There's a few other things to keep in mind. Do you want to take that one, Bay?
Yeah. So this one is a bit of a tricky one to be, I guess, qualified for or be able to access. But it was announced a couple of years ago, the skills and training boost for small businesses. So it's not a 20% refund. It's an additional 20% deduction for expenses relating to the provision of sort of vet-related courses for your employees. So as the business owner, you're excluded from this as a director. And it's got to be provided by a registered education provider in Australia. So this ends on 30 June, but the idea is to upskill your current team into things like Certificate 3, Certificate 4. Yeah, if you're eligible, it might be something you squeeze in before 30 June this year.
Cool.
And there's another one similar. Yeah, cool. This one as well. So this is another one that's finishing 30 June 2024.
Yeah, it's finishing, but it's not law yet. It's yeah, you tell me. So they introduced it, and when they introduced this was a few years ago. They said that, oh, hey, we're going to introduce a small business and energy incentive, but it's going to finish in 30th of June 2024. But we were hoping to hear a little bit more about this. Actually, now tax planning delivery meetings before this date, we've been talking to clients, hey, this might come in before 30th of June. We've got a month to go and do this if it does come in, which is usually what we see is if it comes in quite late, they might extend that into the next financial year. But we actually didn't hear anything about it. So it is actually still in front of Parliament. Go figure, it's ending in 30th of June 24. Most likely than not, they'll change that date at that point. So right now, it's not law yet. So based on the budget, we haven't heard anything. We probably, my opinion in this is we're not going to hear anything before 30th of June. So we might hear next financial year. And what they did with one of these incentives were they put it through to law, receive royal assent the next financial year, and they backdated any of those expenses. But it's really hard to advise our clients, right? Right now, where we sit in front of them and go, hey, you're going to go and fit out this new commercial property, solar panels, energy efficient fridges and dishwashers. Can I go buy them? Maybe is our answer right now. We really don't know whether you're going to get the extra 20% deduction. Now, if it does come to law, it means that if you spent, let's say, $1,000 on it, you get an extra 20% deduction, which is $200 on top of the 1,000 that you spend on. But it's not law yet. We were hoping to hear about it.
And just running the numbers so that people don't think this is just the most amazing thing that's happened ever. If you go and drop 20 grand on qualifying expenses here, you already get a deduction for that, assuming it's business use, and it falls within deduction territory. So 20 grand times by 0.2 is $4,000. And then we times that by the tax rate, equivalent tax rate, which may be 25%. So we take 4 grand, times that by 0.25, and we get $1,000. So for a 20 grand spend of qualifying expenses, this is worth about $1,000 to you. So again, that's not life-changing amounts of money, but it may help. Again, if you're already going to do something like this and you're happy to cross your fingers of maybe it'll come through in law, but I wouldn't be. I'd make it a commercial decision, and this is a bonus versus making the decision based around this poorly executed and late incentive.
Yeah, it's interesting. It makes our job a little bit harder when we're trying to be proactive about our advice. So this is what I mentioned before at the start. I'm just covering off again that they've extended that 20 grand instant asset write-off. There's still conversations whether or not that will increase to 30K. Now, whether that goes backwards to 24 financial year, this one we're in, or proceed forward, that's not law yet. So there might be a chance, and this is just something to keep it in view. There might be a chance that that goes up to 30K, but we're not holding our breath for well, this financial year it's going to finish on that. Next financial year, they announced that it's going to be just 20K, but whether or not they backdate it or they do for future, we're just not sure yet what's going to happen here. It might go up to 30K. Fingers crossed.
Yeah, and just from a tax planning perspective for business owners, this isn't a tax planning webinar, but just a thought: if you've relied on depreciation deductions in previous financial years, that's lowered your tax bill. This current financial year that's about to finish may be a bit of a shock to you without those depreciation expenses. So let's say you bought a vehicle or big piece of equipment last year, and you wrote it off in full, then this year we're not going to be able to benefit from claiming depreciation on it.
Yeah, and I just want to be extremely clear. The part that's not law yet is the increase to 30K. 20K is in. I just want to be extremely clear. The 30K, whether it goes to 30K, it's not law yet. When you read that and you see that, people go, oh, I can't spend it again. No, it's just the increase. Cool. Now, do you want to go through this already?
Oh, this is more of a reminder than a budget thing. And I don't like the way they call it better targeted superannuation concessions, but basically for individuals with balances exceeding $3 million, you don't get that concessional tax rate on earnings of 15%. It's a 30% tax on your earnings. But I think that kicks in. Where's the date? I think it's we probably should have added that to the slide.
Yeah, well,
it's
it's
a year
still
away.
yeah, but it's still in front of Parliament and it's not law yet. It's still being discussed at this point.
It's been discussed for years, I feel.
Yeah, and I think there was a bit of a shock, I think middle of last year, where this became a central topic to a lot of people. Basically, it means that if you've got more than $3 million in super, you're not going to get that concessional tax rate of 15%, right? You're going to get taxed at that normal tax rate of 30% instead. So it becomes a bit of a shock for people who have been planning having super at that point, and it is moving the goalpost a little bit. And that's something that people were holding their breath as well within this budget. So some of the stuff that we've put in the slides is some of the stuff that we've kind of held our breath is we still have to hold our breath on. It might not come in from it didn't come in for this financial year, at least for 2024.
Yeah, and the date on it, I just looked it up. We were talking about 1 July 2025, so we're two financial years away, or just over 12 months away from that being the case. And yeah, I think this impacts especially sort of younger people who were aggressively building super in their 20s or 30s. Their balance may already be exceeding $3 million, but they were acting on that aggressively building super bit when there wasn't this law. So yeah, at the end of the day, we've seen superannuation laws change so many times over the years. This is just another example.
Cool. Next one. This is again more of a reminder, but it is in progress right now. So something to keep an eye out. 2 years away is that there will be a requirement for employers to pay super the same time as they pay salary and wages. Now, this is a significant change from a cash flow perspective, especially if the percentage of super is going to go up to 12% by then. What you might see is instead of having a 3-month delay of payment because it's paid every quarter, your super, you'll have to pay the same time. So if you think about your cash outflow rather than the net wages itself that you pay every week or fortnight or however, whatever your cycle is, you'll have to pay super at the same time. So what you need to have in the kitty needs to be a little bit more than what it was before. But again, it's 2 years away. There's a bit of time to get adjusted. Now, our conversations with our clients has been really to move closer to this as we get to 1st of July 26, because what we're seeing as well on the other side of the coin is if you pay super late, it's really, really bad for your business and obviously employees and things like that, because you actually don't get a tax deduction if you pay your super late as well. So what we've been advising our clients, because there's 3 months worth of super in one hit at the end of each quarter, if let's say you miss paying that deadline, there's 3 months worth of super that become non-tax deductible, and you have to lodge what we call a SGC statement, which is basically paying interest and possibly penalties for being late for that super. What we've been advising our clients is at least take it to monthly or even fortnightly. So clearing your super liability more often rather than waiting for 3 months. Because if we're going to move towards this anyways, we need to start adjusting our cash flow between now and 2026 so that we're more used to kind of the cash flow going up more sooner rather than later. It's not for every business to do that. Some businesses have massive tax bills and their bill cycles are 3 monthly as well, and they have to wait for that 3 month holiday period before they have to chuck it to their super, to the employee super. But it's something that you want to consider. If you can try to move to monthly, if your cash flow allows it, obviously talk to your accountants or talk to us about that. We want to make sure that we at the end of the day pay on time, and keep in mind that it might move towards this. It will move towards this. Why we say it's in progress right now? They've announced it, and this is again government, the way it works. They announced it. Here's what we're going to do, and then they're consulting right now. So they're spending a bit of money consulting to employers,
Much?
governing. Sorry,
How much are they spending consulting?
60 million in consulting. So they're spending $60 million talking to people about how practically this will work. What we predict is it will happen. It's just they're getting the how to and consultation to make sure that it's as efficient as possible and as effective as possible. So that's why it's in progress, but more so from the usual. That's how long it takes for things to implement with government policies.
Yeah, and the other thing is like there's a lot of time and development that's needed by software, payroll processing software, and things like that, and talking to all the government systems and things. So it's not something that can be implemented overnight.
So
Very good. But we're still a couple of years away.
True. So that's all we have for you today. That's the important stuff. Now, where you'll be able to Google this stuff online. Where I think it's important is understanding how does it impact you, your family, and your business when it comes to this stuff. Because yes, there's changes. There's some kind of changes that we know for a long time, like the tax cuts. How does it impact you guys? Now, more importantly, if I could level that up, is how does it impact you for this financial year? How do we make sure that we have a well thought of strategy to take into account some of these changes, like those tax cuts and the super contribution limits changing? So if you're in doubt, or you're kind of not know how does it apply, or you've got really specific nuanced questions about your situation, I highly recommend booking a strategy call with us. And we're thicking it right now with all our clients, and we're going through tax planning with our clients right now and talking to them about this stuff. And really, it's about making sure that you have a strategy, not just for this financial, but going forward as well. But yeah, I thank everyone for taking the time today. I think there was a couple questions in the chat box I saw. Thanks, Benny, for fielding them. Don't know if I missed any, but if we've got a bit of time here, if there's any specific questions that you do have, or you want to kind of jump in, share here, even if it's opinions, overall comments, whatever you want to call it, totally happy for you guys to drop that in the chat box. And obviously we're grateful that you guys took the time today to join us on the webinar. Yeah, let's thanks for dropping some questions. Lloyd, Ian, Howard, there's a few back and forth there.
Thanks, really Lisa.
Thanks, Elisa. Good to see you too. And yeah, Liz was here as well, chatting to us. Thank you. Awesome. Thanks, Liz. Yes, Howard. I know. It's
Isn't it?
It is, yeah. It does become a little bit like, we're just kind of holding our breath a little bit, like, okay, something good's gonna happen. And yeah, sometimes it does fall short of our expectations. But yeah, it's the federal election next year. I think it is next year. I'm pretty sure. I'll have to check that. There's also chats about, we got to show that we have the surplus and doing the budgets, whether that's they're politically driven or not. Again,
purchasing votes. Is that another way of saying that?
Well, yeah, I think there's everyone. It's interesting as I view myself as a commentator to the situation right now, and I look at it and go, okay, I can see where some people can see that as a way of doing that as well. Thanks, Steve. Good to see you, mate. Good to see you here. Thanks, Damien. Really appreciate it. And Jacko, Thanks as well. I'll talk to you soon, Jacko. Thanks, Silvana. No worries. Happy to do that.
Even though it's not
John.
you can say it, John.
You can say whatever you want, John. There's no such thing as you can't say it. You can say whatever you want.
Well,
It's all part of the free country that we live in, right?
is it?
Is it? Very.
We had this conversation beforehand.
I'm pretty sure you
Oh,
did. I'm pretty sure John's shaking his head. Uh,
yeah. We
cool.
need to sit down with Riz, John.
I welcome all sit downs.
Uh, goodness me. All righty. Well, thanks everyone for joining, and have a lovely rest of the week that we've got.
Have a great rest of your week, everyone. Have a good one.